Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and I'm excited to share today's topic with you. We're going to be discussing two compelling growth stocks that have caught our attention: Alphabet, the parent company of Google, and Dutch Brothers, a coffee shop operator with a huge expansion plan. Both of these companies have shown impressive growth potential, but as always, it's essential to take a closer look at their financials and industry trends before making any investment decisions. Let's start with Alphabet. The company has been a dominant player in the tech industry for years, and its cloud computing business, Google Cloud, has been a significant growth driver. With revenue up 32% last quarter to $13.6 billion and operating income more than doubling year over year to $2.8 billion, it's clear that Alphabet is making strides in this space. Additionally, the company's vertical integration, including its own solutions like Gemini large language model and tensor processing units, gives it a cost advantage and control over performance that its peers can't easily replicate. On the other hand, Dutch Bros has been making waves in the consumer discretionary space with its small store footprint and drive-through model. The company has already passed 1,000 locations and plans to have over 2,000 shops in operation by 2029, with a long-term goal of reaching 7,000 locations. With same-store sales growing strongly, including a 6.1% increase in system-wide comparable restaurant sales last quarter, it's clear that Dutch Bros has a winning formula. However, as with any investment, there are potential risks to consider. For Alphabet, the company faces intense competition in the cloud computing space from rivals like Microsoft and Amazon. Meanwhile, Dutch Bros will need to navigate the challenges of rapid expansion while maintaining its brand quality and customer experience. As we delve deeper into these companies' financials and industry trends, it's essential to remember that past performance is not necessarily indicative of future results. It's crucial to do your own research and consider multiple perspectives before making any investment decisions. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're still with us as we dive into the world of finance and technology. Our middle segment today is all about a significant development in the tech industry that's got everyone talking. Broadcom, a leading semiconductor company, has just announced a massive deal with OpenAI, the artificial intelligence powerhouse behind ChatGPT. Now, this partnership is expected to be a game-changer for both companies, with Broadcom set to provide the necessary hardware to support OpenAI's ambitious plans for AI expansion. The deal involves a 10-gigawatt AI rack plan, which is separate from the new customer mentioned on Broadcom's earnings call. Morgan Stanley has taken notice of this development and has raised its price target for Broadcom stock to $409 while maintaining an overweight rating. However, it's worth noting that Morgan Stanley is taking a cautious approach, acknowledging that the potential top-line numbers may be exciting, but avoiding stacking expectations too high. The firm is looking to keep its models clean and avoid double-counting demand, which was initially incorporated into models. This balanced view is essential in understanding the implications of this deal. Broadcom's AI sales have been impressive, with a 77% year-over-year jump in Q1, followed by 46% growth in Q2, and a whopping $15.95 billion in total sales in Q3. The company's product lineup has also seen significant upgrades, including the launch of the Thor Ultra and Tomahawk 6 Davison, which are custom-built for AI applications. As we consider the potential impact of this deal, it's essential to remember that Broadcom's upside story isn't linked to just one megadeal. The company has a diversified portfolio, with growth expected from custom accelerator chips, Ethernet components, and other infrastructure layers. This diversification is crucial in mitigating risks and ensuring long-term success. In conclusion, the partnership between Broadcom and OpenAI is undoubtedly a significant development in the tech industry. While Morgan Stanley's revised price target reflects the potential benefits of this deal, it's essential to approach this news with a balanced perspective, considering both the opportunities and challenges that lie ahead. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're wrapping up today's show with a closer look at the story of Kraft Heinz, a company that's been making headlines lately with its struggles in the market. Now, I know some of our listeners might be thinking, Kraft Heinz? Isn't that just a food company? And yes, they are. But their story is also a cautionary tale about the importance of adapting to changing consumer tastes and staying competitive in a rapidly evolving industry. As we've discussed earlier on the show, Kraft Heinz has been facing some significant challenges. Their sales have been declining, and their profits have taken a hit. The company's planned split has also raised some eyebrows, with even Warren Buffett expressing his disappointment. Now, it's not every day that you see an investor like Buffett speaking out publicly about a company he's invested in. So, what does this mean for investors? Well, the consensus on Wall Street is that Kraft Heinz stock is a hold right now. Analysts are taking a wait-and-see approach, waiting to see how the company executes its next moves. And with a dividend yield of 6.26%, some investors might be tempted to take a chance on KHC stock. But here's the thing, investing is all about weighing risks and rewards. While Kraft Heinz does have some attractive qualities, such as its iconic brands and solid cash flow, there are also some significant headwinds to consider. The company's sales have been softening, and competition in the food industry is heating up. So, what's the takeaway? As always, it's essential to do your own research and stay informed about the companies you're investing in. Don't just take someone else's word for it. Look at the data, consider multiple perspectives, and make your own decisions based on your individual financial goals and risk tolerance. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.